before we go into the momentum, which is an evidence against weak form market efficiency, we want to refresh our memories about the capital asset pricing model. Revisit this one. How? Okay. Well, CAPM in financial management, how did it work? Let's start one by one. When you are valuing a stock or company, right? How would you value it? The DCF method, basics, which is over the infinite horizon, starting from tomorrow, or in the future, right? To the infinity, you try to expect just some cash flow, estimate cash flows in each period and discount it at relevant cost of capital like this. And if your growth rate of cash flow is stable enough or small enough, then what do? Well, use Gordon growth model, cash flow next year, and divide it by R minus G of cash flow, right? So two important things are cash flow and risk, but cash flow is largely what you expect, and it can be all around the place, right? For different companies, who God knows what. But commonly, you can study the discount rate, RIT. Notice in mathematic term notation, subscript, small letters over here, IT. I is for company or security. T is for time point, okay? And then what would you use as RIT? Your stocks, relevant cost of capital or required rate of return, right? Investors are risk averse. That's a basic framework. We start with this. High risk, high return, I want. Okay, otherwise I would not bother to look at that stock or put my money. Come on, right? And then in the first place, I want to get compensated more than risk-free assets. I'm putting my precious money into the risky stock that you are selling it, right? So unless this security is expected to give me better return than the risk-free asset, I'm not going to put my money. Okay, and then in return, you can think expected return for a security, you can understand in this way. So I want to get compensated at least as good as the risk-free asset, right? Start with the risk-free rate. And then I want to get compensated more because it is risky, right? It can tank, it can go bust or bankrupt or whatever, right? Not even before bankruptcy, it can go down like 50% or something. So I want to get compensated for that kind of risk, right? And then risk premium is the idea. And you notice that the I, right, for each different security, you can think about the different risk premium for each different security. Tesla's risk premium, and then ExxonMobil's risk premium, Apple's risk premium, each and every risk premium may differ, right? Would differ. How would you model this one is an important issue. If you send risk-free rate on this equation to the left-hand side of the equation, what happens? Then RIT minus RF, okay, this is an excess return, right, is equal to risk premium I that is left from the right-hand side of the equation, and we can call it excess return of I, okay, excess return of security I. In excess of what? In excess of risk-free asset. Okay, fine. How would you model the risk premium of security I or excess return of I? Okay, that is a question that we want to address in this framework. Not only CAPM, but what we're going to face in the future. Now, how would you model this one? There could be infinitely many different model of risk return. Okay, high risk, high return. How would you model it? How about modeling it by extracting some common factor Z, common factor Z across all different securities, and that plus something simple. Okay, I want to model it with some commonality, commonly moving together across different stocks. Of course, this commonality could be one thing or multiple different things, but just for the sake of simplicity, just stay with one thing, one common thing. And then something simple, CAPM, right, tells us that only one risk factor is needed based on the market portfolio. Okay, portfolio theory is a good starting point because it gives us one common factor, starting point factor, which is market portfolio in excess of risk-free rate. We're going to talk about it a little later. So based on market portfolio, you take a long position of market portfolio, and then risk-free asset, short position US Treasury, which means borrowing at risk-free rate, and then with that money, what do? Invest in market portfolio. That's RM minus RF. That's what you're expecting in this market portfolio, market risk factor portfolio. And then the excess, this is the excess return of the market, as it turns out. Excess return in excess of risk-free return, right? So that's the expected return that you can see in your market portfolio, as long as you are taking short position of your treasury or risk-free asset. And then this is nothing but the market risk premium that we've been talking about. We talked about in financial management, RM minus RF, exactly the same thing. It is determined. The thing is, market risk premium, okay, the excess return that you can expect from the market portfolio in excess of risk-free asset. This risk premium is determined in the market as a function of risk aversion of the investors, real time. Every time, if the investors in the market are more risk averse on average, then the risk premium should increase. On the other hand, if the average market investors are getting less risk averse, give me more risk, this kind of setting, RM minus RF will shrink down. The risk premium will shrink down, right? And it is, risk premium is determined in the market every day, real time, all right? We call it the price of risk, the price of risk. It is commonly shared across all stocks, and then all the market participants are price takers, and the companies are price takers as well. And so the securities get priced with this price of risk, market risk premium. The invisible hand of the market determines it. Okay, now what the heck are you talking about? Some of you may wonder, but bear with me, please. How would you model the risk premium? All securities are different from each other in terms of the degree to which they are sensitive to the risk factor. I told you, let's consider some kind of a common risk factor. Common factor across all different securities. Once you extract that security, extract that commonality across thousands of different stocks. For each different stocks, what matters is the sensitivity of your stock to the common factor. Common factor, well, in CAPM, we just have one common factor, which is market factor. Okay, how would you express that different degree of sensitivity? Well, let's call it beta, a sensitivity measure. We call it this sensitivity measure beta, and then this another name of it, economic name of it, is a quantity of risk. Quantity of risk for stock I, and each different stock I have different beta I. There's different sensitivity measure to the commonality, common risk factor, market risk factor, RM minus RF. So when you look at the risk premium of each different stock I, Tesla's risk premium, which is Tesla's expected return minus risk-free rate, then this is none other than this, right? Beta times the market risk premium, which is quantity of risk, the left element, beta, quantity of risk I times the price of risk, right? The price of risk is commonly shared all across different stocks. Tesla's price of risk, the same as the Amazon's price of risk, which is called market risk premium, right? Oh, didn't you say this is risk premium of Tesla? No, I said risk premium of Tesla I is the whole thing. Market risk premium multiplied by the beta of Tesla. So market risk premium is different from risk premium of Tesla to the extent that there is a beta I. Beta for Tesla is there. And market risk premium is something common across different stocks within a market. We call it the price of risk. Okay? The average investor's risk aversion determines it. As investors get more risk averse, this price of risk increases. And that affects not only Tesla, but also every stock in the market. Exxon, Apple, you name it, Netflix or Nvidia, Micron, Samsung, internationally Samsung or whatever, it will go together, right? Every stocks share this price of risk. The same thing, the market risk premium. But every stock has different beta, different sensitivity. They take different quantity of risk. That's how we talk about it, right? These jargons are maybe tough for you, right? But if you try to grasp it one by one, slowly go ahead and you'll figure this out. You see this rectangle, right? This is rectangle. The area of it, I call it the risk premium of Tesla I, right? Tesla, this guy. The area of it is a multiplication of this and that. And this is price of risk, right? And that is quantity of risk. And just like the demand curve and the demand curve or whatever, supply curve, I showed you the economic convention. The vertical axis is a price, and then the horizontal axis is quantity, right? So I'm just following that habit. Each different stock has different risk premium, but you can understand it or decompose it or interpret it in a multiplication of this price of risk and quantity of risk. Market risk premium and beta. Okay, the area will be different for each different stock. Well, factor. Did I say factor? Risk factor. Yes, it is. This is CAPM can be understood as a risk factor model. Okay, and that factor, does that come from engineering, machine learning, or factor analysis in statistical term? Yes, it is. Right? You can reinterpret CAPM as a variation or kind of a factor model or factor analysis in machine learning sense. So what do you see over here? Over time, the graph shows 500 different stocks in the S&P 500 composite, right? 500 US stocks, their monthly returns are shown over here. It goes everywhere, different colors, right? And then what is the commonality over there? That's S&P 500 index return, which is the average of all these guys. So commonality sounds right, something very spooky, scary, but average is one of the one kind of commonality that you can infer out of it. So common movement among thousands of different stocks over time, the return of market portfolio. That's it, right? So RM, that's this. And then RM minus RF, you just extract or subtract the risk-free return. That RM minus RF, this will be the really commonality in terms of premium. So market risk premium, that's the idea. Okay. Now, having said that commonality, we can construct a portfolio like market portfolio over here. How does that market portfolio perform better or worse compared to the risk-free asset? So RM minus RF, you construct the RM minus RF portfolio over time and test how it performs, right, over time like this. And if you accumulate those returns and either compounding those excess return or accumulate those excess returns, then you'll see a graph like this. Starting from the US market, starting from 1926 up until 2012, right? It has been performing in this way. If you follow compounded excess return, and you can see that it tells us a lot about what we experienced in the stock market. Also, if you look at the log excess return, it shows dramatically about it. You look at the 1929 Great Depression or stock market crash in 1929, the Black Monday thing or something. You see a huge decline and then rebounding back. And then every time there is a stock market crash or crisis, you see a dip over there, right? 2008 financial crisis or Asian market financial crisis, like that. You see it happening. So we can infer reasonably, this market factor portfolio, RM minus RF, market factor portfolio performance over time makes sense. It tells us the coherent story about what happened in the US market or in the global market as well, right? And then once you have the construct factor portfolio, okay, what would you do? Well, you show and back test the market portfolio, factor portfolio performance like this. And then also CAPM, right? Getting back to our CAPM discussion, we need only one risk factor like this, RM minus RF market risk factor. And then let's express it as a model of RIT. Starting from this, the starting point of CAPM is excess return on excess return. You're trying to explain the excess return of Tesla using the market excess return in excess of risk-free asset. So because this premium to premium explanation. So each different stock's risk premium should be explained by one common risk premium. Okay? And then the only difference should be explained by this beta. Your ultimate measure of risk is beta in CAPM, right? One single beta. Let's express it as a model of RIT. So leave this guy in the left-hand side and then send this guy to the other side of the equation. Then it becomes RF. And then you see plus beta times RM minus RF. In fact, this is what you've been memorizing ever since your financial management class, right? Why did you have to memorize it? Well, because it's easier to memorize, but easy to forget as well. But in this way, if you try to understand it, originally it is excess return explained by market excess return, okay, multiplied by the stock's beta. Then it's difficult to forget. You just send this RF to the other side of the equation and that's it. Boom. And in fact, RM minus RF is determined in the market real time, as I said before, market risk premium, and is applied to all different stocks commonly. Then we realize that the equation is a linear equation, is a line, straight line, with respect to beta. Okay, beta. It gets back to y equals a plus bx form, the line equation that you learned in your high school math, right? Y equals a plus bx form. But the interesting thing is the x, we try to use beta as the x variable in this setting. So let's change the position, okay? Change the position so that RM minus RF, the risk premium, is on the left-hand side over here, and then the beta is on the right-hand side. So we can clearly show that the equation is about, the relation between the expected return and the beta, the market risk degree, okay? Because you've been memorizing these, right, in this form only, it is difficult to chew. And then why is there risk return trade-off? And then why is beta is such an important measure of risk? Well, here you are. This is the x variable, not the RM minus RF itself, but the beta itself is the x variable. Y variable is this one. That guy is an intercept, and this one is your coefficient or slope term. This one is a slope term because it is commonly shared across all different stocks. So what do you mean? Well, security market line, if you remember. This RI on y-axis, beta on x-axis. This one is only the slope term. Security market line is derived like this. So high risk, high return shows up naturally. High beta, high risk, high return, RIT. Okay, that's it. High risk, high return. This one is not a risk itself. I told you this is a price of risk. Price of risk, the quantity of risk that you carry differently for each different stock is captured by beta. Okay, clear. Now, security market line. If you use data for US market, I tried it this year in this summer. And then using the data of October 2020. Remember, this is monthly return, right? Monthly return. And then here is a beta that I estimated for all 3,500 plus different stocks in the US market. I estimated the beta, right? You see 3,000 plus dots over here in our scatter plot. Wow. And then beta is on the x-axis. And then for each different stock, I got the future return, 1 month return going forward in October, right? So October return, and then before October, the beta of this stock was like this, ranging from -2 to +4. And then the returns, you see negative 60% to 100%, right? Over there. Within a month, 100%. Right, like that. Of course, there are some many stocks whose return turned out to be more extreme than this, but I Windsorized it. Windsorize, what do you mean? This is a data management technique so that trim off that value. If it is 200% or something, I replace those return to something 90% or something. So 99th percentile value, I replace it. I Windsorized it. And then it shows like this. If I run a regression based on these scatter plot, I can see that the slope is like nicely positively forming. So I see higher risk, higher expected return, high risk, high return being realized in the month of October 2020. Okay, this is a security market line that we've been studying, right, in financial management class, right? You see the slope term over here. This is a market. What is that? Risk premium, market risk premium, 9.6 percent or something on a yearly basis. I think it has to be, but anyway. So the monthly return, I must have said this is annualized return. It's not a monthly return, but annualized return. So monthly return times 12, right? So that's why it's 9.6% market risk premium that I obtain in this regression. So that's that. But I said this is real time. The market risk premium changes over time. Right? In financial management, we learned as if market risk premium is just fixed. Okay? Many decades or something, it's just fixed. That's kind of easy way of saying the market risk premium. If you go to the advanced level like this class, right, you realize that the market risk premium is determined in real time and it changes over time. So if I move down to November 2020, remember this is October, but I moved down to November 2020, the security market line, I can obtain it one more time. And it changes. The slope term is now 2.9, okay, instead of 9.6. Drastically changed. Wow. Depending on the data points, it can drastically change. So security market line itself, you can estimate it, but it is very noisy. How confident am I to claim that this is the market risk premium? How confident am I? I'm not that confident, right? It has a lot of noise in it. So we estimate it with some noise, right? But just as an illustration for you, it is a noisy. Okay, CAPM security market line, it's noisy, and beta is noisy as well. Okay. But the beauty of CAPM is that the stock's excess return relative to U.S. Treasury or risk-free asset should be completely explained away by one factor, market risk premium, excess return of stock index relative to U.S. Treasury or Korean Treasury, depending on the country that you are working on. One shot killing every bird, everybody. And then one shot kills everything. Beautiful and simple. So they won the Nobel Prize. Okay, one risk factor explains every risk thing, right? Risk premium. Assuming the CAPM is correct, let's test if market is efficient. Okay, how would you test it, right? Well, characteristic line. Once you can think about a characteristic line for each different securities for thousands of different stocks. Okay. Using this excess return framework, your stock's excess return should be explained by market portfolio's excess return. Okay, and then over time, right? Maybe trailing 5 years, right? Trailing 5 years, 60 months, right? 60 months, you have this return data of your stock, risk-free asset, and then market portfolio or Kospi index return, and then risk-free asset return, again the same thing, and then time point by time point, you subtract all these things, and then you will have your excess return of your stocks column and then excess return of your market portfolio, right? Two different columns, and run regressions, run a univariate regression. That slope term will be beta, and then intercept will be alpha. And it seems familiar, right? Except that the risk-free rate is on the left-hand side of the equation instead of what you memorized in the last semester. Anything not explained by the factor, right? The factor over here, factor portfolio, RM minus RF. Anything not explained by the factor is lumped into this intercept. That's something not explained by this risk factor, right? But CAPM, okay, it explains everything, so that nothing is left. Nothing is left. Assuming CAPM is correct, we are assuming this alpha will be 0 on average, right? For each different security, the alpha I may be different from 0, but if you obtain those, estimate those alphas across thousands of different stocks within Korea or within the United States, CAPM being correct means that those alpha on average will be 0. Okay. We assume that alpha equals 0 on average using Kospi index return and Korean treasury rate, daily return of each stock, then run regression and get alpha I across all securities and test if these hold, right? If alpha on average is 0. Okay. Now, I did it for Naver and Kakao. Like this. The slope term is beta that you see, right? You see Kakao has higher beta, which is riskier in terms of systematic risk, right, than Naver, right? And you see intercept term over here. That's alpha, as long as these Y and X are excess returns. And these are not 0, okay? What is more important is we obtain alpha not just for two different stocks, we have to obtain thousands of alphas for thousands of different securities in Korean market and test whether these alpha are equal to 0 or not, right? That's our null hypothesis. And assuming CAPM is correct means that on average, those alpha, the average of those alpha will be 0. That's our prediction. Assuming CAPM is correct, let's say you have an investment strategy to beat the market as a portfolio manager, i.e. generating positive alpha. Okay, alpha better than risk-adjusted benchmark, CAPM. Using historical data, backtest if whether such investment strategy may have really generated positive alphas or alphas that are different from 0. Okay? That will be testing of CAPM as well as your investment strategy, your ability as a portfolio manager. Across different time periods and portfolios, you get alphas, right? Different years, different decades, maybe. For different portfolios you form, right? Alphas. Then test if alpha is equal to 0 on average. This is null hypothesis, alpha being 0. But the Pharma's, Eugene Pharma's testing in 1970s, right? They usually found out the average alpha is 0. Okay, you cannot reject the null. You could not reject the null. But what if you reject the null in your data, right? If you find that alpha is not equal to 0, is market inefficient based on that result? Or is your assumption wrong? The assumption that the CAPM is a right asset pricing model, or both, these two, okay, is a serious question that we're going to address later. Now, next video, I'm going to talk about momentum in that respect, using CAPM as our right asset pricing model. So, thanks for watching this CAPM refresher, okay? See you.